Welcome back to another episode. Today I'm really excited for this one. Are you a founding business that is looking for investment? Maybe you've reached out to a VC, maybe you're looking how to create the ultimate pitch deck. Today we've got Tim Wynn from Blackfinch Investments. Welcome.
Hi Ollie,
How are
nice to be
you?
here. Yeah, good, thank you very much. How are
Good.
you?
Yeah, very good, thank you.
Good.
We have so many questions. I know we've had quite a chat off air, but I think there's so many startups right now, founding businesses that, as we mentioned, are looking for investment. Where do we start? Who to contact? How long is the process? So, first of all, I think it would be great if you could just kick off and give us a little bit more information about yourself, the business, and we can go from there.
Sure. So good to be here. Thanks for having me. So Blackfinch is a multi-asset investment firm, basically. So we've got a number of different parts of the business. We have Blackfinch Energy, which owns and operates wind and solar farms in the UK. So we have about 120 megawatts of assets. That doesn't mean much to most people. So to give an idea of scale, it's about 50 sites throughout the UK. And we're slightly different from other financiers and investors in the space in that we do actually own those and operate those assets. So we enter into the energy offtake agreements with the utilities, for example. We've got our own operation and maintenance team in-house who actually maintain the wind turbines, etc. So that's a really well-established part of the business. Blackfinch Property provides debt into commercial property development construction projects. So we do a lot of urban regeneration. We own quite a lot of real estate within the UK. And then we have asset management. So that's public listed equities. So we effectively act on behalf of our clients to invest money into stock market and various publicly listed markets. And then last but not least, we've got Blackfinch Ventures. So that's the venture capital part of the business that you've already alluded to. And within that, we invest in startups, early stage companies, typically with a technology slant, but we'll get more into that, I'm sure, in a bit about the type of areas that we look to invest. And we have a number of different funds within that venture capital arm of the business. So we've got a venture capital trust. So that's a publicly listed trust, and we have an independent board of directors on that trust. And our clients invest into the trust. We then invest into startups, typically in the VCT, Venture Capital Trust. Those are slightly more mature businesses than the Enterprise Investment Scheme, which I'll come on to in a minute. But with that vehicle being publicly listed, it then pays a dividend. So we've been really pleased to pay out a dividend to our investors twice within the last year. And then they get what's called special dividends when we exit a company, i.e. we sell that company onwards to a private equity house or a strategic acquisition. So that's one of the funds. The other fund is the Enterprise Investment Scheme Fund. So that's slightly different from the VCT in that it's not listed. We invest in individual companies. Now, some of them may be the same type of companies as the VCT. We may even co-invest from the VCT in some of those companies. But we invest our clients' money in individual companies. But we always try to invest in at least 10 companies on their behalf. And that's to give them diversification, to make sure that they're invested in different stage of company, different types of tech, because some companies will succeed and be incredibly successful. Unfortunately, others may not and will fail. So that's why that diversification point is really important. And then lastly, which is my particular area of focus, we've got an energy transition fund, which is essentially energy tech. So that's another EIS fund where we invest in technologies that are driving the transition away from fossil fuels to green energy and clean tech. So that's not wind and solar farms, that's our energy business. It's more things like electric vehicles, batteries, heat pumps, solar panels, software platforms that can make all of those different assets work together, etc. So that's, a bit about Blackfinch. And then to your point about how does a company actually seek investment and how do we go about that? So we've got a really established process where we have a team within the ventures space part of the business. That team's fantastic because we have a lot of ex-founders in the team, and we've got a couple of PhDs as well. So deep technical expertise, but also we've got direct operational experience in the markets in which we invest, whether that's energy, whether it's fintech, whether it's you name it. And so within the team, we do quite a lot of outreach. So we've got proprietary tools. We've got some AI software that we use to actually identify companies that we think are at the point of raising. And we think that's really important because it means that we can speak to those companies first and actually develop a relationship and understand their roadmap.
So that's before, so you're reaching out to them directly before they've even come to you?
Exactly.
Oh,
yeah.
wow.
Which is really powerful, as I say, because sometimes they say that's a bit spooky. We
Yeah.
were literally talking last week about the fact that we're going to press ahead with our raise, and we say, "Wow, what a coincidence!"
Yeah.
But no, that's a really good way. Other times, companies will approach us, whether it's they've seen stuff on our socials or the website, or they've seen us at events. We've got a good reputation within the market, so quite often other VCs might recommend that people speak to us. So it's a bit of a mixture of push and pull in terms of how we actually find opportunities. And then we've got within the team associates and analysts who do the first pass. So they'll look at the company pitch deck, they'll speak to the founders, a brief phone call, maybe half an hour, to understand the basic principle and is this a business that looks like it's on mandate for us? Is it the type of area that we're interested in? Are there any immediate red flags? If the associates like it, they'll bring it forward, and we'll review it as a team and then invite that company into pitch. And that's a really important part of the process, really, because that's the first time we as a team get to meet the founders and whoever they bring onto that pitch. And again, that's really interesting to always see who's on the pitch, what areas do they cover, etc. Maybe I'll pause there and then we can talk about what comes after that.
No, thank you very much for that intro. Obviously, so as a new business that's starting out, when setting up, how do I kind of get myself ready for investment? If I'm going to be seeking investment, how does that process work? And what do you guys look for from us when we're actually getting ready to establish a company? I know you mentioned EIS, so how do we get EIS ready, for example?
Yeah, so typically there's certain sort of stipulations that you need to be EIS eligible, things like advanced assurance, which is essentially sort of a certification almost of type. So there's various kind of housekeeping bits like that. Again, that's all very easily available online. The EIS, Enterprise Investment Scheme, is a government endorsed scheme. Rachel Reeves in the last autumn budget, doubled down on it and actually extended the scheme out to the mid 2030s, and it's been going for 30 years. So there's a lot of information online that's very easily accessible to explain what it is, how to become EIS eligible, and usually companies are ruled out of being EIS eligible because they're too mature. So if they've got over a certain level of assets, then they won't be eligible for EIS, but they may be eligible for other funds. So there's that kind of housekeeping bit, making sure that you have the basics in place. Beyond that, it really then becomes about your product and your business and your team. So we bearing in mind that the EIS is typically sort of C to Series A in the funding cycle. So we very rarely see a company that's literally just been incepted. We're not. There's a previous fund called SEIS, which is much more focused on very new companies at the very sort of incubation phase. And we work with a number of incubators again who they'll literally start companies from the ground up and then sort of launch them out into market, and we're the next logical progression that those companies would speak to as they look for their next round of funding. So we're not getting involved directly at the kind of incubation phase. Usually when companies see us, they will have been incorporated maybe anything from a few months to a few years typically. What we like to see is some revenue traction. We do invest pre-revenue sometimes, but it's the exception rather than the rule, because ultimately we have a responsibility to our clients and their money. So and there are certain things which I'm sure we'll come on to about the horizons that we look to in terms of how long we will invest in companies when we look to exit, etc. So we will typically be looking for, have you got a compelling product? What's the experience of your team? Is there clarity and simplicity around your offering? Because if there's not, then that's a challenge. If we can't understand it, then chances are it's not going to be scalable. So that's not to say that the tech that sits behind the product can't be complicated, and it's great if it is, because that means that sometimes it makes it much more defensible and a lot more intellectual property and things like that involved. But at the front end, if it's complicated, then I think you've got more work to do to try and simplify it and make it very compelling, very clear what your proposition is, because that shows us that A, you've put that work in, and B, your product or service is going to be scalable. So that's those are the really important things up front.
Okay, cool. I mean, that makes a lot of sense. So it's just clarity over your proposition and making sure that you've got a good, solid business plan, and then reaching out to you. So when an organisation is trying to look for a VC, what sort of areas should they be looking to for that VC? Like, how do they conduct their own due diligence on the VC?
Yeah, great question. And we really like it when we see companies approaching us who have done that DD, and have actually taken the time to understand our business. And some of the most important things are just researching the fit. So I mentioned, Holly, before some of the sort of areas and themes that we invest across. So we've already mentioned energy transition as one particular theme, and we are becoming increasingly thematic. So there's energy transition, which we're very well placed to do because of the expertise we have in-house around energy, background of many of the team. We also have a particular interest in science and deep tech. So again, that's one where we're building a really good track record in that space. We're anything from sort of very novel energy generation projects and products right through to kind of satellite imagery and things like that. And then the next area is really around software and SaaS. So we've invested in HR tech, fintech. So it's really important to us that companies who are approaching us for investment understand that those are our focus areas and understand where they fit within that.
Yeah.
And actually, as you just gathered, that's very broad. Even the energy space in itself is very broad. We could be looking at buildings, we could be looking at transport, we could be looking at industry. The deep tech space, obviously, again, so many different applications of deep tech. But a fundamental understanding of that is really important, both for us, but also for the company that are pitching to us, so that they know that we can actually bring more value to them than just money.
Yeah.
It's really important.
Just talking on that value add proposition that you guys have with Blackfinch, how you just alluded to that you don't just provide the money, you also help them scale to the next level. So how do you kind of run that process through?
Yeah, so we, as I mentioned before, we've got a lot of in-house capability and we take a lot of pride in that. And actually it's been really interesting for us since we launched the Energy Transition Fund. We've had a lot of companies, after they've met us at the end of the pitch, say, can we just say it's really refreshing to speak to a VC who really understands this market. And that's great for us to hear as well, because it's real validation in what we're doing. But the same thing goes for, as I mentioned before, we've got exited founders within our team. We've got Rich Harley, who runs our portfolio, for example. He ran his own edtech business and got it to 5 million ARR and then sold it. So and then he's now come in-house and runs our portfolio company. So he really understands what it takes to make a company successful, make it attractive for exit. And that's just one example. We've got Nick Pillow, Dr. Nick Pillow in the team as well. He has a PhD in computer vision. He then had his own startup, sold it successfully, moved into the corporate which acquired that and helped them with their sort of new business processes and things like that. So that operational experience really, really helps, because we do understand the day-to-day sort of peaks and troughs and challenges of running a startup and getting it fit. So that's one thing that we do on the value add side. The other side is, again, within our wider business, one area that we didn't mention, but you're very familiar with, is we actually have an intra-company startup. So we started a part of the business called The Hatchery, which effectively is our kind of own incubator for our own, so you see what we did there. We've launched a business through that called Thrive, which is offering a very consumer-led pensions and benefits platform. So it's for small and medium enterprises to enable their employees to have a better experience of their pension and employee benefits. So where's my pension invested? How much have I got in my pension pot? You'd be amazed how many people don't know that. And how can I maximise that? How can I plan for my retirement? Through that, we have our own team in-house that have developed that entire software stack. So we've got a CTO who is exceptional, Sam Barton, who's been able to then support our ventures portfolio companies as well. Because if they've said, right, we've got a particular challenge in our product roadmap or our tech roadmap, we've sent in Sam to help them. So that's again, and same for the energy team. Again, we've introduced so many of our network through our energy team who have worked all over the industry across clean tech and renewables to companies that we've invested in. So that's part of it. It's very much our kind of internal network. There's then our external network. So we've got about 120 what we call venture partners. And again, these are typically people who've had direct operational experience in these industries, many of them exited founders, but there isn't a one size fits all in that network. We recruit into that network and build that network based on the needs of the portfolio companies. So for example, we've had companies come through recently that were great on tech, really, brilliant product, understood the product so well in their own minds, but didn't have experience of actually being out in the market selling and thinking about, okay, what are our routes to market? How are we going to treat partnerships? How are we going to treat direct sales? How are we going to treat, affiliate sales and referrals? So we were able to bring in an advisor from our network who's got direct experience in doing that, and just really help them with the sales strategy, and that reaped a lot of benefit for them and for us.
So it's never just really one person that's supporting it. It can be just bringing in from all these different areas to fill out the team and support.
Precisely, and we can do that both formally and informally. So quite a few of those venture partners we will appoint to the board of the companies that we invest in, so there'll be a non-exec. We don't mandate that, but more often than not we do like to appoint a non-exec to the board, and then one of the Blackfinch team will be the board observer. So again, there to observe, but can also offer insights and support and say, okay, hang on a minute, I can speak to somebody in-house about that. But then there's also ad hoc support. So we've got a founders WhatsApp group. There's about 70 odd founders in there now who are, it's very dynamic. They're, quickly drop into the group. Has anyone got any recommendations for SaaS? Has anyone got, we're speaking to a marketing agency. Has anyone used these guys?
Yeah.
So that's very dynamic and it's very helpful to the founders. And so we take a lot of pride in that, and it's really important that we do develop that kind of ecosystem to support the founders, so that, again, like I say, we're not just writing a check and say there's the money, because that's not going to differentiate us enough, and it also means we're not going to maximise the value of our investments.
And I guess given that you've got that support network and you've got given the investment, how long is it before it comes to a point where you say, okay, this is the results that we expect? This is the time you've got to turn it around before it's kind of like, what, maybe this isn't working?
Yeah, it's a really good question, and there's no one size fits all, because every company we see is different, and that's not just based on sector or product. It's based on the team. It's based on how mature they are as a business, how many paying customers they've already got, are they still in pilot phase, etc. So there isn't a one size fits all, but we do tend to agree with the company certain KPIs. And we'll have monthly reports, we'll get monthly management accounts, we'll get monthly commentary from the CEO, which is literally highlights, lowlights, any other important business. And as I say, we'll attend monthly or bi-monthly board meetings, etc. So we take a kind of quite an active monitoring role, but we don't become draconian in terms of saying, we need this, and this, because ultimately these are busy people running a company and desperately trying to get their company off the ground and flying. They've got enough on their plates without us saying, could you please fill out this spreadsheet and do this and do this? So we try to make it as seamless as possible. But we do need some rigour around it, obviously, because again, ultimately we are responsible and the custodians of investment from our clients. So we need to make sure that there is proper governance around it, and these companies are acting in a structured way and being efficient with how they use their resources and their cash.
So what kind of happens if a company hasn't met KPIs or things start to go wrong? I understand that you've got kind of like a safety net where you can parachute your own team in to actually help advise and push the business or take the business out of trouble. But what happens if everything kind of fails? Where does that leave the business, and how does that kind of work?
So I think the first important thing to say is we have to be prepared to let companies fail.
Yeah.
Which sounds maybe counterintuitive, but again, to the point about our clients' money, we can't throw good money after bad, and so we are very clear. We're regulated by the FCA. Ventures is classified as high risk investment. There are certain loss mitigations around that. So if a company does fail, for example, if you're invested in the EIS scheme, you get what's called loss relief. So you do get a proportion of your investment back through tax relief. So there are certain safety nets there, but again, at the same time, we don't want companies to fail. We want them to succeed for obvious reasons. But at the same time, as I mentioned before, if we're invested across 10 different companies because we've wanted to diversify that investment and sort of spread risk and reward, we have to accept some of those companies are going to fail because that's the reality of the startup world. So we won't keep companies on life support indefinitely and just do follow on after follow on just to keep the lights on because it's just not good practice. But where we can intervene helpfully, we will. Now, it's important to stress we can't control these companies. We don't fully acquire them. We don't own these companies. We are investors, and we have board seats, so we have a certain degree of influence. But we can't force them to do action A over action B. But we put a lot of effort into the relationships with the businesses, so they don't see us as a another thing on the to-do list. That they can actually say, look, there's an issue here and we need to address it and we're not quite sure how. And we say, okay, great, we'll help. And sometimes that's around recruitment. Sometimes it's facing some pretty difficult decisions about cutting costs, which again, needs to happen sometimes. Or it could even be about reorganising the top team. And just saying, look, guys, you've got the right people, but are you in the right places? Are you playing? Are you all playing to your strengths? And so hopefully we can just be that extra pair of eyes and ears and objective counsel to help the businesses through those rough times. And we've seen. I could give you loads of examples within our portfolio of where companies have pivoted. They've started out when we invested doing a certain something, and they've got X years down the line. And suddenly, whether by accident or by necessity, they've suddenly found an amazing product market fit for their product in somewhere they weren't expecting.
Wow.
And so then we say, right, great, we can help with that.
You just run with that.
Yeah, and we go. So it is a balance. And we do a lot of monitoring so that we can try and preempt some of this as well. And so that it's not just them coming to us with a problem. We can sometimes say, guys, there's a little watch out over here. But then once we're kind of aligned on sort of how we can help, great, let's help. It's kind of hopefully that very kind of proactive relationship driven approach rather than an investor approach who you just feel, well, yikes, the investor's asking for this, everybody panic and run around like headless chickens.
I think that's actually really beautiful that number one, from a investor's perspective, so if I'm investing into Blackfinch and you're managing my wealth, I think that really helps me and gives me a lot of comfort to know that you guys are actually looking after my money and you're going out there and giving them additional support. As we mentioned off air, there's a lot of VCs out there that will just throw money and just wait and see what kind of happens, but you actually go out there as a safety net, really try and push the business and promote it to the next level. We're also talking about off air about how you guys look at future trends as well.
Yeah.
And the types of organizations that you invest into have to be kind of really groundbreaking because it's not so much what happens this year or next year. Tech's so fast evolving.
Yeah.
So how do you kind of monitor those trends that are coming up?
So it's obviously a really interesting area and one that it is, there's no right or wrong answer sometimes. But just to sort of ground it a bit, we typically look at a 4 to 7 year exit horizon when we invest in a company.
Wow.
So we'll be thinking, and we need to hold the investment for a minimum of 3 years under
Doesn't
regulations.
seem long at all, does it?
And for some of these companies, it won't be. Some we fully expect it'll be 10 years, and those are the ones who are doing the more groundbreaking sort of
numbers.
But typically, we don't invest in R&D stage companies. So we want to invest in proven tech, proven teams. With proven traction, okay, and if if you're not one of those things, again, maybe question whether you're coming to the right investor. And again, it's quite telling sometimes whether companies have done their homework on that, because quite often, if you are very novel R&D, you won't be coming to this type of VC. Yeah. You'll be going to somebody who's more like an SEIS fund or a knowledge-intensive type fund, etc. So yeah, we back to your question, phase about sort of future trends and future trend scanning. So firstly, we've got to think that there is a realistic prospect of that company exiting within that 4 to 7 year horizon. So a lot of very early stage tech, that's just not realistic. And it's going to take more capital up front to get those companies off the ground. There are other companies that we think, wow, this could be sold within a matter of a year. But again, we don't want that because we need to hold the investment for 3 years. So, it is a balancing act. And so when we're sort of future scanning, we've got to be careful of a couple of things. One, as I say, is going too early in a company's growth cycle, or tech development, product development cycle. And the next one is really avoiding hype and the hype bubbles in particular, because we see so many companies. I can't tell you. I mean, to give you an idea, we probably see well over 1,000 companies a year. Yeah, well over that. And then actually, when we first launched the Energy Transition Fund, the team did a Herculean shift, and I think saw in the vicinity of 1,500 companies in about 4 months. But did an amazing job at filtering that down. So we filter it down. This is all part of the process of the team. So we'll kind of have the initial view, as I mentioned, with the associates and the analysts in the team. Next stage of the funnel then is kind of a bit that kind of light touch initial DD. Then there's the pitch, which is the most involved part, where we get the team in front of us. We typically do that over about 3 hours. It sounds a lot, but it means that we can really understand the company. If it's just an hour, people are very polished. They've done it before.
Yeah.
And you need to have time to actually ask questions and uncover. Sort of, and also it means we can observe. We will have some people on that pitch who don't really say very much on our side, but they're there just watching. How are they responding? How are they responding to these questions? How are they responding to challenges? How are they responding to pressure? It's all really important for us that we build up that picture. And then we get to the end of that pitch, and if we want to take it forward at that point, then we'll move to term sheet, and then we'll do some more very sort of detailed technical DD in the background. So I'm sorry, Faze, I've forgotten your question now because I completely strayed away from it.
How do you basically dig deep into the trends that are coming?
Right. Yeah. So, and that was the point I was making. So we see so many companies, right? And as you can imagine, we see some wacky ideas, and we see some that we think, wow, that's completely wacky and it's never going to take off. We see a lot that we think, wow, that's really wacky, but there's something there. But as I said, we've got to be very careful that we're not getting sucked into hype, because sometimes the founders themselves can be so incredibly enthusiastic about their product or service, and can be incredibly convincing and charismatic. But you've got to separate that kind of enthusiasm and passion for what they're doing from the realities of the market. But you've also got to consider market noise as well. So again, AI, you can't go anywhere at the moment without people talking about AI. And that of course there's massive value, and we are very closely looking at all sorts of AI solutions. But if we were to believe every AI hype story, then we would have just shut up shop on everything else and just invested in AI, and that's not the way we want to go. We want to make sure that we do diversify and that we've got a good blend and balance across our portfolio.
It's actually quite funny. Quite a lot of VCs right now are actually shifting away from investing in AI and more grassroots stuff, more actual physical product, or more actual hardware,
and infrastructure.
So talking about hardware and infrastructure, if I'm a tech startup that's come up with a new product, how difficult is it for me to actually launch in the UK and kind of competing with global markets? And
for hardware specifically?
For hardware specifically.
Yeah, so it is a challenge. And again, if I use the energy tech space as an example, so much of clean tech, new clean tech, so think battery technologies, electric vehicles, heat pumps, solar panels, is coming out of China. And China has gone for it. I mean, they're being called the electro state. and because they don't have natural oil and gas reserves, so they're going all out on electrification. So that means clean energy generation, storage, but a whole swathe of digital technologies to enable that as well. But what China's got is obviously very low cost labour. It's got a lot of raw materials. And so as a result, it's very challenging to launch energy tech hardware products in the UK if you're not buying from China. That creates supply chain issues and risk around supply chain, volatility of commodity markets, questions around ethics within the supply chain, around slave labour, for example, things like that. So it creates a lot of challenge. And if we do try and onshore manufacturing within the UK, typically you're going to struggle on price because our cost base is just that much higher. So that is a real challenge. But again, we've seen companies actually seeing that as an opportunity to say, well, look, if we can develop a digital tech tool to completely demystify that supply chain and de-risk that supply chain, then that's a great business idea.
Well, that's how Streamline started off.
There we go. So I think it presents challenges and opportunities. But again, we see a lot of businesses in the UK will come up with exceptional ideas, and then they can contract manufacture it. They don't need to manufacture here within the UK. They can outsource manufacturing to the Middle East or to China or etc. So, but there's always a balance to strike there, and that's why also another key thing we look for is intellectual property. So we it's very rare, I think it's fair to say, that anybody comes to us with a completely new idea that no one's ever done before, or that we haven't seen somewhere else. But the technology or the thought that goes into that, if it's IP protected, then does create much more of a defensible moat, effectively, from other people just copying that idea. So that's always something we're keen to see, is that has the company filed for patents? Have they been granted? How deep are those? How wide are they? What does it cover? Because sometimes people say, oh yeah, it's completely patented, and then we see the patent and we say that's not worth the paper it's written on.
Right.
So it is really important to have thought about that, because it's one of the things that we major on is, and if there isn't IP, if there aren't patents, if there isn't IP, is there suitable defensibility? Because actually other people just wouldn't be able to do what they've done because they've gained such a great head start on the market, and other people would find that market very difficult to penetrate. Sometimes that can be as good as a really well-written patent. So you've just got to think about that, about how truly unique is this, and how do we make it defensible so that a competitor or an original hardware manufacturer couldn't just say, oh, that's interesting, copy it, and completely outsell us and outprice us.
I think that happens quite a lot.
Yeah.
But in terms of the founder, so we've discussed about the actual product itself. How important is a founder when investing into them, and what kind of qualities are you looking for as a founder?
So first part of your question, critical.
Yeah.
It couldn't be more critical. And we probably spend more time as a team after pitches talking about the founder and the team than most other areas. And that is because we've seen it so many times that we know that a startup is never a straight line. It's never just going to go from there to there, ever. There's going to be challenges. There's going to be peaks, troughs. There's going to be victories. There's going to be a lot of pain and heartache. Yeah. It's a really tough thing to do. So you need to see that the founder has resilience, has charisma, has is well networked, etc. There's certain things we look for there, but the most important thing is that the team is backable. Yeah, that's one of the most important things, because sometimes we might say after a pitch, and we've said this many a time, I don't think they're quite there on product, but that team is brilliant, and we'll back the team, and they'll work it out. Yeah. Or we'll help them work it out. So it is that important, because so we don't just look at grey hairs. It's not just experience within the team. We're not saying, okay, well we need teams that have got 20 years experience, 30 years experience in the market and know everyone in the industry. It's more, and some of this is quite subjective. It's the founder qualities. Are they hungry? You know,
Yeah.
have they got the desire? Have they got the staying power? Are they coachable?
Yes,
Is one that
'cause you
we
don't
talk
want
about
someone
quite
that
a lot.
knows everything.
Amazing. I mean, you know, sometimes we will get that. You know, we'll have people assume that, you know, we can possibly understand their product as well as they do, or the market as well as they do, and they'll talk over us during pitches, and they'll, you know, and you sort of think, oh, that's a red flag, you know.
Have you ever had a situation where you love the team, apart from one person that you just think that there's no way we could work with you, and you've had to say, you know, we can work with you guys, but this person may have to step out on this occasion?
Not that I can think of,
Okay.
to be honest.
I mean, I know that's savage,
Yeah.
but you just never know. You never know.
We've definitely, you know, you're always going to get a mixture of personalities and characters within these teams, so we've definitely seen some people who are very bullish, others who are very bearish, you know, and overcautious, or some that, you know, speak too much, others that don't speak enough, you know. So you see every colour of the rainbow there, you know. It's really interesting, but you know, obviously that's not anything we would want to do, is actually come in and say, right, we'll invest in you if you get rid of.
I think that's where a really well balanced team comes out. Like with us, for example, I'm very much blue sky, very much open thinking. Everything's going to work out perfectly.
Yeah.
And then one of my business partners, Sheikh, he always brings me back down to earth.
Yeah.
And he's always saying, right, have you thought about this, that, and the other? Have you thought about the risks of what you're doing right now? So I think it's quite important that you actually understand that there's a well-balanced team. I think those personalities really help drive the business forward.
Yeah, 100%.
And also eliminate risk as well.
Yeah, it's important to have that. I have a question around equity stake. I think it's quite an interesting one when you're a founder business as well. You want to try and save as much as your business as possible, but also you've got to appreciate you need to give something away, right, when you need investment.
Yeah.
Is there usually a marking point where you expect a minimum percentage? I like the fact that you guys do give support, and actually the fact that you do, I think people would be more willing to give away a larger percentage of that. But not a lot of people understand that some VCs offer that.
Yeah. It's another really good question, and it's one that, again, is about finding a balance. Unfortunately, we do see some companies that we really like, but they've just got very unrealistic expectations of the valuation of their business.
Right.
So, you know, and so there have been a number of occasions where we've had to say that, and we're very careful that's not misconstrued as us trying to drive down the value of the business.
Yeah.
We just try to be realistic. And so sometimes we'll say, look, we really like the team, we really like the way you've approached it, we like the product. Unfortunately, that valuation, we just can't do it. And that's because, again, we have a responsibility to clients about balancing our portfolio, about you know, balancing risk. So it's never a straightforward decision, but there are a number of occasions where we do need to say that. And in terms of our stake, it'll vary massively, because we're investing in companies and technologies and people at different stages of their growth.
Right.
For some businesses, you know, we may want to take a larger stake. Others, we're willing to take a smaller one. An example recently, this was a really interesting one. We and this is in the public domain. We invested in a company last year called Supercritical, which is developing. It's a hydrogen electrolysis, so it's electrolysis to produce green hydrogen. Really interesting company, and our stake, compared to what our typical stake is, was much smaller, and we invested alongside Shell Ventures and Toyota Ventures. So, you know, we're quite accustomed to leading the round and taking a significant proportion of the company. In this instance, it's a smaller stake, but alongside some strategic investors, and that company is really exciting and doing some really interesting things. Other companies, as I say, we might come in to lead the round. There might be some other co-investors as well, but like I say, it will really depend on, firstly, the traction that the team has shown, whether they're revenue generating, etc., etc. So there's a lot that goes into how we value companies and what we're willing to move to in terms of our stake.
So when I'm a founder, I'm doing my valuation of my company. What sort of metrics should I be including, and how do I not overcook the numbers or undercook the numbers?
Yeah, and again, it's a big question, but it's a good one. I think the most important thing is obviously being able to justify the valuation, and the way you can justify the valuation is through tangible proof points rather than kind of hypothesis and projection. So again, we are obviously revenue is a key metric, and if you are revenue generating, great. And again, all of the basics, profitability, but again, we appreciate a lot of these companies aren't going to reach profitability for potentially years to come. But even if it's not that, if we can see letters of interest and expressions of support from strategic buyers, things like that, and so it's really kind of proof points to say, look, what we're talking about here isn't just theoretical. We've actually gone out to the market. We've got customers. We've got proof points. We've got partnerships. We've got the supply chain in place. That makes it much easier to justify a valuation than we've had a great idea. Nobody else has had this idea. Okay, but until you've got those proof points, then it makes it very hard for a VC to really go for it. And of course, sometimes we need to just back our own conviction, and we do. But there are other times when anyone can sit down and make an Excel model, a spreadsheet, and just say, look at this amazing growth of our company. So this is what we're worth because by 2030 we're going to have sold this many units for this much money. But then if we drill into, okay, how did you get to that figure? Sometimes it'll be like, well, we're going to capture 65% of the market. I'm like, really? 65% of the market? Wow. So,
do you ever take on companies that may be in debt or may have just got an incredible business idea, just haven't had that conviction or have just struggled, but you can see the potential there? Because I think we always assume that they have to, have success and be making money. Like maybe they're just not at that point, like you say, where they just need a little bit of a fine tuning.
So do you mean specifically when they've got debt that they've used to
build
in the
company,
a bit?
To build a business? Or...
Yeah, so it's always a question we ask as part of our initial due diligence. So at pitch, we typically ask that, say, any debt in the business, and that might be directors' loans, it might be convertible loan notes, it might be angel investors with a certain preference or whatever it may be. And it's not unusual, and it's not. But what we really, again, want to watch out for is, are they being disciplined about that? And is there good sort of capital efficiency within the business? Because if people are taking on debt and they've got a really high burn because they're employing loads of people and they haven't sold a product yet, then again you've got to think, we've got to be very careful there. But if it's debt that has furthered their business and got them to a position where they are now where they can scale, then that's prudent use of resource and etc. Another thing that I should mention, of course, is grants. And again, off air, we mentioned a bit about this. Grants are really important. So we, again, if we've seen that a company has attracted a grant or funding from Innovate UK or from other of the kind of UK incubator type grants and funds, then that's fantastic, because usually that's non-dilutive as well. So they're not taking a share in the company; they are giving that grant to further, examples we've had recently, and we've had loads actually of. But we invested in a company decarbonising commercial shipping. So they're putting wind propulsion systems on commercial ships to reduce fuel use.
Wow.
And they've been very successful in attracting grant funding for that. And that's brilliant, because again, it's because it is furthering the UK's kind of overall knowledge economy around how do we decarbonise this massive issue. But conversely, we've got to be very careful, and we do see this again as a bit of a red flag. If someone's just gone grant.
I was just going to say, would you suggest that's like a great starting point to kind of, get VCs is to pick up as such?
Yeah, I would suggest don't go for every grant going because it happens to be a grant. Again, make sure it's the right fit for you, that it works for your company, that it is actually genuinely progressing you towards your business goals. Because otherwise, we've seen some companies that have been going for 10 years who have never made any revenue. It's just been grants, and you just think, well,
Wow.
okay, that's not, that's extreme.
Yeah,
I wouldn't say we
yeah.
see those all the time.
Yeah.
But that again, it's really important that we do actually see genuine, product revenue or service revenue, as opposed to, we've been successful in attracting a series of grants and we're still developing the product. So it's a balance.
Just leading on from that, do you invest into organisations that have developed an MVP, so a minimum viable product, just to test concept, just to test the market, and that are looking for now taking the next stage and actually developing a full-fledged product? Is that predominantly the route that you prefer to go?
Not necessarily. We certainly have done, and will do. Continue to. So, and again, depending on the nature of the business, so there's the various sort of technology readiness levels, TRL, and so I think it goes up to TRL 9 or something like that. So that's specific to sort of certain types of tech. In more software-driven businesses, sometimes MVP, but we've got it out. We're testing it with customers. We've had great feedback. We've already got paying customers. Fantastic, great. And let's now, because sometimes what our funding is key to unlocking is then the development of the beta product, and then the etc. to take it to the next level of development. None of that happens organically without fuel, and the fuel is the money that we can put in.
So from an MVP perspective, if an organisation hasn't developed its own tech stack, but using a third party's tech stack to actually kind of do a soft launch, but they have the ambition to actually have their fully owned tech stack, is that something that's quite attractive for you? Or
again, I don't think there's any one size fits all in that instance. It's usually, again, it's a bit like the IP point. If a tech stack has been built and it's fundamental to the project and it's entirely dependent on somebody else's software, then sometimes that's a big risk, and we need to flag that as a big risk. But that's not to say that, again, we don't have companies coming to us who've built a tech stack using third-party software because they've had to get to where they are. And some of it can remain third-party, and other bits of it they may want to bring in-house and develop themselves. So, it'll massively vary on the application. But again, it's probably rare that we have companies that own the entire tech stack. Where they do, it's really interesting and great. But again, that presents risk sometimes as well. So, it's about, this is why the diligence process is really important, and why we put so much stock on it. Again, it's something we ask at the pitch. Sort of, right, talk us through your tech stack, talk us through how you develop that, and you managing that in house, and have you, et cetera, et cetera. So, it is pretty in-depth for that reason.
So something we discussed off air briefly is just about the time scale of this. We've talked about stacks, we've talked about meetings, we've talked about, you guys going off and speaking to your external sources. How long from approaching a VC to the end of, we want to work with you, how long is that process?
I'm going to sound so repetitive and boring here, but it will vary massively depending on no one size fits all. But but it's important. Obviously, a lot of companies underestimate the time it takes to raise.
Yeah.
And that is, to say that, to go, as you said, from point of going out to start the raise process to completing raise, you may be looking at 6 to 8 months.
Wow.
We would pride ourselves on being quite responsive and quite quick, as long as the building blocks are in place for us to be able to do that. So the way we typically approach it, as I say, is that we've done that initial due dil. We'll have the pitch. We then aim to come back to companies within 48 hours after the pitch. And I appreciate I've made it sound pretty daunting, I should think, going through tech stacks and all this stuff, but it is a well-oiled process. And if at that stage after the pitch we want to proceed, then typically what we'll do is write up a short form IC paper, and we take that to our investment committee. So that's both a quality and governance step for us, but also it makes sure that, for whatever reason, we haven't been entirely biased and won over by a very hypnotic, sort of CEO or something. And we can call ad hoc investment committee meetings. And some of our investment committee are internal, others are external. We make that a deliberate point again, so we have some subjectivity and objectivity even within the process. And then we'll move to term sheet. And so that process from pitch to signed term sheet could be done in 2 weeks. And has been. The team's really, really good at turning stuff like that around. Sometimes it's more the administrative stuff, like I mentioned, advanced assurance, for example. That can take a bit of time to sort out if it's not already in place. So usually we would like to think that if there are delays in the process, it's not anything we're doing to hold it up. It's just the nature of the process.
Yeah.
But it will vary depending again on quite often. If there's a rush in the process, it might often be, as an example, somebody needs to have secured the investment to secure their next round of grant, for example, or something like that. So they might say, well, listen, we need to get this grant in July, and for that we need to have evidence that we have a signed term sheet.
Right.
Now, obviously we don't like being held to a barrel, but that's an example of where we would then say, right, if we've got conviction in this company, we can move quickly.
Right. And a no doesn't mean no forever, right?
No, it really doesn't. And it's very telling actually how many companies either do or don't keep in touch with us after pitch, and it's impressive when they do. So if we've said no, then I would, particularly if we've given positive feedback, or even if we give negative feedback, come back and prove us wrong. But do keep in touch, because it's very rare that any startup is going to do one round and bang, done. And so we do quite a lot of follow-on investments into our portfolio companies. I think we've probably averaged 3 or 4 follow-ons in our companies over the course since we launched the funds in 2019 and 2020 respectively. But also we've seen some companies where we've said no, and then at their next round we have invested. I think it's really important to keep in touch and to seek as much feedback as you possibly can as well. If we've said no, then find out why we said no. We offer feedback, but do make sure you get that as much as possible, because that will help in your next round and etc. And then the other thing I should mention actually is, even if we don't invest either in the first tranche or in a follow-on, we're very active within the VC community. So we co-invest with other companies. We will say to companies that pitch to us sometimes, look, you're not quite the right fit for our portfolio, but we think you would be for X, and we'll introduce X. So again, I think you've got to treat the VC community as a network that you need to leverage and you need to work hard.
Yeah.
Because if you just go to one and they say no, and you say okay, and then you go off to another, you're probably
really
missing opportunity. Yeah.
Let's talk about the exit strategy. So, does a founder need to have an idea of how they want to exit, or do they need to have kind of a long-term plan of what they want to do with the company? Because some founders go into an organisation and that's all they want to do for the rest of their life.
Yeah, great.
So how does that exit strategy look from an investment perspective, and what are you kind of looking for there?
So they do need to be willing to exit.
Yep.
That's first. If they want to be there for life and don't want to let go of their baby, then they're probably not. Again, they've probably not done their research coming to a VC. So yeah, we do need an exit. I think the important thing about exit is you don't need necessarily in the early stages to know exactly who you're going to exit to.
Okay.
Or even, so we'll ask some founders and say, thoughts on exit, and they'll say, yeah, it's likely to be one of these 3 companies. And in some of them, maybe that's realistic because they have developed something that is particularly acquirable and strategic for one of those investors, whether it's an energy company or a telecoms or a bank or whoever. So that's fine. But more often than not, we probably expect founders to say we're fairly open at this stage. It might be an IPO, we might list. It might be a strategic exit, i.e. we sell to a corporate, or it might be private equity. So I don't think it needs to or should be set in stone. But again, it's a positive sign when you see a founder who's thought about it, because ultimately you need to be building that business to be acquirable.
Yeah.
That feels quite overwhelming though, because a lot of people would be coming to you to help build out. So the thought of even having to consider exit, given names of who they would exit to, that to me would feel super overwhelming.
Yeah, I probably didn't quite phrase that right. I don't think we would ever say, who are you going to exit?
Specifically.
Yeah, specifically.
Yeah.
But it's more the thought process behind it. And again, that will change over the
Yeah.
course. Again, if we're looking at a 4 to 7 year exit horizon, potentially longer, there are going to be so many developments within a month, let alone a year, 2 years, 5 years, within the journey of that business. So it could be that, as I said before, a business pivots, suddenly finds itself, or has engineered an opportunity for itself to sell to a brand new market segment, and suddenly an acquirer becomes very obvious, because it might be somebody they've sold into their product into, where it's a really good fit for them, and you can see the strategic value and etc. So that you can't really, you can't sit there on day one and say, I know exactly where we're going to go, because it's just not realistic. But again, if you're never thinking about exit, then that's a problem. So there's a lot of balls that these founders are having to juggle, which we sympathise with, but we do help with that as well. That's again exit, and so Kim and the team is from an M&A background. She, we put a lot of thought into, again, RVC and PE, private equity networks, and strategic acquisitions and things like that. And when we do advise companies not just on follow-on investments, but also on exit opportunities as well, because it's as fundamentally important to us as it is to them.
Of course.
Perfect. So you can literally help straight from the start of a company's inception right the way through to exit, which is beautiful. Totally random question, but do you ever help organisations that haven't got investment from you? Do you ever help them with exits?
I can't think of any examples, to be honest. I mean, we through network and our network effect, there may be times that I or other members of the team get a call from somebody we know who has invested in a company, another VC, for example, who say, any chance of an introduction to, and so there's that kind of natural networking bit, which for us is incredibly important, as I mentioned before. I can't think of any examples where we've helped a company that we haven't invested in to exit, but there's no reason why we couldn't, as long as it was in our commercial interests,
Makes sense.
You've added an extra sideline of the business for them, haven't you?
I did. Sorry about that. But we've spoken quite a lot about the investment journey from a founder's perspective and an organisation's a startup perspective. What about from a investment perspective? How do you secure your own clients that are investing into you? How does Blackfinch manage portfolios? What sort of risk levels do you take?
Great question. So, and it's something remiss of me not to mention in the intro, actually, to Blackfinch. So Blackfinch is predominantly retail investment. We work via independent financial advisors, and we've got a network of IFAs throughout the UK. And we've got regional business execs, basically, throughout the UK, who manage their own patch and their own network of those IFAs. We spend a lot of time with the IFAs. We do annual roadshows to go out and meet them. It's part of their CPD, continuous what's CPD? Continuous professional development, I think. Because we're obviously going out to talk to them about how we build our funds, the type of companies we're investing in, etc. So that's a big part of what we do. So our typical investor is a retail investor who is looking to offset some tax, which is, again, entirely legitimate through is UK government backed and endorsed. Effectively, when you invest into these funds, you get tax relief. And it's a proportion of the investment that you've made rather than your total tax liability. But that is it's an incentive for people to invest in these various funds. So that's how we go about building that position. as I mentioned before, we also have our asset management side of the business, and that's where it's not tax advantaged investment. It's more of investing in listed equities, for example, and that's where we offer either a tailored portfolio service, TPS we'll call it, where effectively we build an asset portfolio, an investment portfolio for advisors to help them manage their client money. Or we have various other types of arrangements like that where we can look at different fund structures and things like that on behalf of our clients. And another area is IHT, so it's inheritance tax, and that's where again effectively our clients can invest in things like our property business or our energy business, and that means that there are various benefits to that in terms of how much inheritance tax they pay or how much they're able to pass on to the next generation.
Brilliant. So a lot of security there and a lot of opportunity as well.
Yeah, and the important thing there is that those different funds have different investment mandates. So you mentioned, sort of about our approach to sort of building funds and things. So things like energy and property, certainly the energy assets, they're long-term assets, very steady, predictable returns, very well suited to that kind of inheritance tax desire and mandate. The ventures investments are higher risk, potentially higher reward, shorter term. So again, what we do alongside the IFAs is really understand what are the key drivers, what are the key things that our ultimate clients need. Is it that they want to save for some lovely holidays, or is it that they're planning for their retirement, or is it that they want to do some estate planning? So that takes some consultation with us and the IFAs to really understand their objectives. Then we can match that to our various different funds.
That also matches in quite well with Thrive and what you're doing there in the pension side.
Yeah, precisely.
So we've signed up to Thrive, and it's going to allow our employees to actually choose where they want to put their investments, where they want to maximise on their pension pots, if they want to increase their pension pots. So it makes sense why you've gone into that venture as well.
And it's a really exciting part of the business. As I say, we've launched it as an intra-company startup. Like I say, it's a very logical progression for us as a business. But also we just recognised a fundamental need, because you'd be amazed how many people don't know how much is in their pension or where their pension is. And certainly in previous generations, people had jobs for life, and a single pension pot. Now most people have had multiple jobs, change jobs maybe once every 2, 3, 5 years. So they may have multiple pension pots spread out all over the place, don't know where they are, don't know how much is in them, don't know what they're invested in. So it's for us, it was an area that needs to catch up with the 21st century and modern day life. It should be that people know how much they've got in their pension, they know where it's invested, they know if they should be putting more into it or whether they can afford to maybe reduce their monthly contributions, whatever it may be. But again, it's understanding and giving them the ability to understand for themselves, okay, if I need a certain level of income in retirement, then maybe I should be thinking about this option. Or things like, and we can give financial education and coaching around that. So, it's kind of the way that we actually have positioned that part of the business is actually really sort of good understanding of finance and financial health. And that's really empowering for people, I think.
I'll be the first sign up.
Financial literacy is really important, and it's not actually taught in schools. And it's good. It's a good tool for helping our employees actually understand where they're investing into. But
this has been really enlightening and opened my eyes, and I know it's going to impact. Has it opened your eyes?
A hell of a lot.
yeah, it's crazy, and I feel like everybody needs to watch this episode. It's been so helpful. Is there anything you wanted to add to that?
No, thank you very much, Tim, for coming down. And if anyone wants to get in touch with Blackfinch, log on to Streamline. You'll be able to access all of their services and also investments from there.
Perfect. Thank you so much for joining us.
Thanks for having me.
Over and out.